Step 1. Business quality and economic moat. Business model. Ryan Specialty is in the specialty insurance brokerage, underwriting business. They provide insurance solutions via wholesale brokers, agents, managing general underwriters, binding authority units, etc. Think complex risks, non-standard insurance contracts that require specialization, property casualty, professional lines, etc., rather than plain vanilla insurance. Is it easy to understand? Moderately. It's more complicated than a pure consumer business, for example, Coke, because insurance has underwriting risk, regulatory risk, cyclical losses, etc. But the model of brokerage plus underwriting plus risk management is fairly well understood. Economic moat, potential sources, relationships, network with agents, carriers, brokers. They have many specialty producers through which they distribute. That takes time and credibility. Specialization. They focus on specialty lines which often require expertise, claims handling, underwriting knowledge, that can protect against casual entrants. Scale via M&A plus organic growth. They've done acquisitions and scaled revenue 20% plus in past years, which could create advantages in pricing, underwriting data, and cost spread. Weaknesses. Insurance is highly competitive and cyclical. Losses from catastrophe events, regulatory changes, and reinsurance cost fluctuations are risks. 8. The moat doesn't look unassailable. Other players, Aon, Marsh, etc., also have scale and skill. Management. The founder, Patrick G. Ryan, is highly experienced in insurance. He built Aon previously, which is a plus. There is a formal succession plan. He has moved to executive chairman. Timothy W. Turner is CEO. Others have been promoted. That suggests some planning. Conclusion. Management is reasonable, knowledgeable, and experienced. No major red flags. Step 2. Financial health check. Metric value. Buffet. Target ideal comments. Return on equity row, approximately 16.98% greater than 15% pass. Above target. Very high leverage. Free cash flow FCF tilde, $510 million on tilde. $2.8 billion. Revenue consistent, growing positive and growing. Up approximately 43% year over year. Debt obligations remain a risk. Net profit margin approximately 2% stable or expanding. Thin margins. Brokerage tends to run lean, but this is still low. Earnings growth 5-year AVG, not stable. Recent revenue growth approximately 20 to 25%. YoY consistent growth. Growth is strong, but earnings volatile. Step 3. Valuation analysis. Valuation. Metric current value compared to history. Industry comment. PE ratio approximately 113, much higher than industry. Extremely expensive. PB ratio approximately 22 times, much higher than peers, suggests overvaluation. Other metrics. EV/EBITDA also elevated, high versus peers, not cheap by any measure.
Discount rate.
Assuming approximately 10% treasury yield plus risk premium. Intrinsic value estimate. Model suggest tilde $53 to $56 versus market price around tilde $51 to $52. Margin of safety is negligible. Long-term outlook. Industry trends. Specialty insurance demand grows as risks, cyber, climate, supply chain, litigation increase. Industry cyclicality remains. Catastrophic losses, reinsurance costs, inflation pressures. Competitive position 10+ years. They can maintain an edge if disciplined, but high leverage and thin margins make resilience questionable. Reinvestment opportunities. M&A and geographic expansion. Growth in specialty lines. Analytics and technology for risk selection. Debt may constrain some of these opportunities. Step 5. Final Buffett-style assessment metric. Buffett, standard current value pass. Understandable business, yes, yes. Strong economic moat, yes. Moderate, row greater than 15%, greater than 15%, approximately 17%. Debt equity less than 0.5, 0.5 to 5.99. Consistent FCF, yes. Positive, growing. PE reasonable, yes. Greater than 100. Margin of safety price less than for slight at best. Trustworthy management, yes, yes. Overall verdict. Ryan's specialty has several things Buffett likes. Good ROE, strong cash flow, growth, and experienced management. But the negatives outweigh them. Extreme leverage, razor-thin net margins, and eye-watering valuation multiples with virtually no margin of safety. This looks like a growth story priced for perfection, not a Buffett-style value opportunity. A better entry point would require either much lower price or major deleveraging.